Hello everyone, and welcome back to the channel. Today we're diving into a question that vexes many approaching retirement: what to do with your pension's tax-free cash. It's a tempting pot of money, often available as soon as you turn 55, soon to be 57. But should you take it? The truth is, there's no one-size-fits-all answer. It depends on your individual circumstances, financial goals, and risk tolerance. However, by understanding the factors involved, you can make an informed decision that's right for you. In this video, we'll explore 7 key scenarios where taking your tax-free cash might make sense and when it might be better to leave it untouched. We'll weigh the pros and cons, and I'll give you my honest opinion on each. So, grab a cuppa, settle in, and let's get started. Now, let's be clear from the outset. Your pension is designed to provide income throughout retirement. It's a long-term game. However, there are times when short-term needs must be addressed. If you're grappling with high-interest debt, like credit cards or payday loans, using some of your tax-free cash to clear them can be a shrewd move. Think of it this way: you're effectively using your pension pot to pay off debt that's eroding your finances at an alarming rate. The interest saved can often outweigh the potential growth you might have achieved within the pension, but a word of caution: don't raid your pension lightly. This strategy works best for truly burdensome, high-interest debt. If it's a lower-rate loan, like a mortgage, the math might not add up. Always crunch the numbers carefully, and if in doubt, seek advice from an independent financial advisor. Remember, depleting your tax-free cash now may lead to higher tax bills later when you start drawing your taxable pension income. It's about striking a balance between addressing immediate financial pressures and safeguarding your long-term financial well-being. Now let's talk about a little-known trick to potentially boost your household's retirement income: using your tax-free cash to top up your spouse's pension. Let's say your partner has a smaller pension pot than you. You can gift them some of your tax-free cash, which they can then contribute to their pension, often with added tax relief. This can be especially beneficial if your partner is a higher-rate taxpayer, as they'll get more tax relief on their contributions. This strategy allows you to share the benefits of your pension wealth and potentially increase the overall income you'll both receive in retirement. Of course, gifting a portion of your pension savings is a significant decision. It's crucial to consider your own retirement needs and ensure you're not jeopardizing your financial security. But if you're in the fortunate position of having ample retirement savings, this strategy can be a tax-efficient way to bolster your partner's pension pot. Now, let's talk about the elephant in the room, the lifetime allowance. This is the maximum amount you can build up in your pension pot over your lifetime without facing additional tax charges. Currently, it stands at just over £1 million, with a quarter of that, £268,275, available as tax-free cash. Now, if your pension pot is projected to exceed the lifetime allowance, any growth beyond that limit might be subject to tax penalties when you come to access it. It's like a ceiling on your pension savings. This is where your tax-free cash comes in. By withdrawing some of it and investing it elsewhere, such as in an ISA, where growth is also tax-free, you can potentially avoid exceeding the lifetime allowance and incurring unnecessary tax charges. It's a bit of a balancing act, as you're essentially choosing between potential growth within your pension and the flexibility and tax advantages of an ISA. It's a complex area, and seeking professional advice is highly recommended if you're approaching the lifetime allowance limit. Chapter 4. Don't blame the pension wrapper. Now, some people choose to withdraw their tax-free cash because they're unhappy with their pension's performance. And I get it, we all want our investments to grow, but here's the thing. Don't confuse the wrapper with the contents. Your pension is simply a tax-efficient wrapper for your investments. If your investments aren't performing well, it's usually not the pension itself that's the problem, but rather the specific funds or assets your money is invested in. Instead of cashing out and potentially missing out on future growth, consider reviewing your pension's investment strategy. Can you switch to better performing funds within your existing pension? Could you benefit from a different asset allocation? Remember, pensions are designed for the long haul. Don't let short-term market fluctuations or past performance cloud your judgment. Review, adjust, but don't necessarily abandon ship. Chapter 5: Future-proofing against rule changes. Let's face it, pensions are a political football. Governments change, and with them, pension rules can change too. Now, I'm not saying a radical overhaul is imminent, but some worry the generous 25% tax-free cash entitlement could be reduced or even scrapped in the future. While no one has a crystal ball, taking some of your tax-free cash now could be seen as a hedge against future uncertainty. You're essentially securing a portion of your pension savings under the current rules, just in case the goalposts shift later on. However, it's important to weigh this against the potential growth your pension could achieve over time. It's about finding a balance between mitigating potential future risks and maximizing your long-term retirement income. Chapter 6: When life throws you a curveball. Now, for a sensitive but crucial point, if you're facing health challenges or have a medical condition that may affect your life expectancy, accessing your tax-free cash early could make sense. After all, retirement planning is about enjoying the fruits of your labor. If your health is a concern, taking your tax-free cash allows you to access and enjoy your hard-earned money while you're still able. It might be used to fund medical expenses, make home adaptations for comfort and accessibility, or simply tick off bucket list items. Of course, this is a deeply personal decision, and it's essential to discuss your options with loved ones and seek professional financial advice. Chapter 7: Passing on your wealth. Finally, let's talk about inheritance. If you're fortunate enough to have more than enough for your own retirement needs, you might be thinking about how to pass on your wealth to loved ones. Now, pensions are often seen as the last asset to give away in inheritance planning. Why? Because until April 2026 at least, they sit outside your estate for inheritance tax purposes. This means that, unlike ISAs or other savings, your pension pot isn't usually subject to inheritance tax when you die. This can make it a very tax-efficient way to pass on wealth to your beneficiaries. Even after the current inheritance tax rules change, drawing income from your pension and gifting it to loved ones can often be more tax-efficient than cashing out ISAs and gifting the proceeds. Outro: the tax-free cash conundrum. So, there you have it, 7 key scenarios where accessing your pension's tax-free cash might be a savvy move. Remember, there's no right or wrong answer. It all boils down to your individual circumstances, goals, and risk appetite. Take your time, weigh the pros and cons, and don't be afraid to seek professional financial advice. Your pension is a valuable asset, and making informed decisions is crucial to securing your financial future. Now, I'd love to hear from you. Would you take your tax-free lump sum now, or would you leave it untouched? Let me know in the comments below.